Hi, good morning, and welcome to day three. My name is Sean Bradley, and I head up the securitization group within AFME. This is the first day that we have had a private credit summit within Global ABS, and for me, there's a huge logic in doing so on this day, given the substantial overlap between private credit and securitization. I think it's the definition of private credit, which no doubt will be discussed later, covers, like securitization, it's an umbrella term to cover so much. But clearly there is a substantial overlap with securitization. So it'll be interesting to see how today develops that theme. The day runs through till 2 o'clock, so it's a pretty full day, and the conference concludes at 3 p.m. After lunch. So I hope you can stay to the very end and enjoy the day. There's also a Future Leaders stream running next door for anybody who is interested in doing so. It's the first year that we've done that as well, and I think will be very interesting. Special thanks to Ares Management, who is the lead sponsor of today, and Joel Hulsinger is leading a keynote at 10:15, so we look forward to that. I think we have a really interesting agenda today, which covers off a lot of related topics in relation to non-bank financing, fund financing, direct lending, and asset-based financing as well. So I think, I look forward to hearing whatever everybody has to say. And we're going to start off, if I can ask Tom Lemon from Global Capital to come to the stage to kick off the first panel on the rise of private credit. And I believe we will start off by trying to define that term, which I think will be very helpful for me at least. So please welcome to the stage the first panel. Thank you.
Hello. I think we can sit anywhere. Oh wait, there's a seating plan.
Oh, there is. I nearly got it.
Here we go.
Oh, I think I got it. Right?
I'll stay up here. 1, 2, 3. Well, welcome. I'm Tom Lemon, the Securitization Editor at Global Capital. Thank you for joining this panel. We've got a really full house of experts that will try to sort of demystify private credit and explain what the future holds for the sector and how it's going to affect securitization as well. There's so many of you, so why don't we go in a line and introduce ourselves, starting with Neha.
Hi, good morning. I know it's bright and early, so thanks for joining our panel today. I'm Neha Koda. I run loan strategy for BofA Global Research. I work out of New York, so I'm still jet-lagged. I'll do my best.
Hi, my name is Paddy Rath. I'm a partner in the Finance and Capital Markets team at Walkers in Dublin. We work mainly on securitization and structured finance transactions involving Irish Section 110 companies, but we also advise a number of asset managers on the establishment of investment structures for various asset classes, including direct lending, loan origination, and private credit.
Hi, good morning, everyone, and thank you for joining us on day 3 of the conference, which I know is a challenge. If history is anything to go by, I'm a director at S&P Global's corporate ratings within the leveraged finance team, but I also sit in the private markets council internally, which basically aims to bridge the gap between market needs and maintain relevancy for our ratings for the very evolving and rapidly evolving marketplace, which is private markets.
Hi everyone, I'm Jason Brown. I'm a partner at Victory Park Capital. We're a US-based firm, but operate globally, Europe, Asia, Australasia really. We are an asset-backed private credit fund. We've been around 17 years. We manage about $6 billion or so now through multiple vehicles, both UK vehicles and US-based vehicles.
Hi, good morning, everybody. My name is Saru Dagli. I'm one of the founders of Riskland. We provide analytics and data and securitization management, mostly these days for private credit markets, for insurance companies, asset managers, working mostly in the asset-based financing space. We are a US-based company, but our clients invest in US, Europe, and Asia.
Hi, good morning everyone. My name is Boris Redfern. I'm the head of buy-side at Levenue. We are a marketplace that operates all across Europe, active in 12 countries. And we originate and source, underwrite, and then service direct private credit deals between mostly ultra-high net worths, family offices, etc., and SMEs across Europe.
Aren't you glad I didn't say all that myself? Right, so we hear a lot of terms within private credit. I think we've got asset-backed finance, direct lending, specialty finance, NAV and fund finance. Can we maybe start with Jason and maybe Boris, if you could chip in as well, sort of go through those in a bit more detail and try and sort of explain what we really mean with the terms, because I know there's so many, and actually working in the US, I see sometimes we have different terms that mean exactly the same things across different continents. So yeah.
I'm sure the panel will correct me on some of this too. And I'm also Australian, which has a whole other set of terms in that market. In the securitization market, there is incredibly different. But anyway, so direct lending, I think, is probably the most common and really the term that's probably been around the longest in my mind. When I look at direct lending, I really break it into two kind of segments, which are the largest segments globally, I think, which is the sponsor and the non-sponsor. So I think we see a lot of direct lending funds that are just lending to anything from small to medium to large size businesses, and obviously the larger the business is, the more possibility that it's going to get a rating around it. But I look at direct lending really as two distinct focuses into a sponsor and non-sponsor kind of market, and obviously a lot of the sponsors at the conference, I think, play in both ends, and I think it's a very different kind of underwriting, very different type of structure and leverage profile, that a business gets, obviously, if it's sponsor and non-sponsor, and that segment I think has really been around, by far the longest. My prior career was at GE for many years, and we did a lot of direct lending into the sponsor and non-sponsor universe back then through Antares. Capital that's obviously still around and still quite a large large global business. When you look at the asset-backed side of things, I think you can also, depending on jurisdiction, break it into a lot of different categories. Broadly, asset-backed, obviously, there is some kind of an asset or a contract that has some kind of cash-generating contract that can be underwritten, discounted, cash flow back. So I think you've got two kind of segments that are more hard asset versus soft asset broadly in asset-backed. It could be IP lending. It could be legal litigation finance, which is a smaller niche growing area. But I think all that as an umbrella fits into asset-backed finance. Depending on your jurisdiction, you can have a massive ABL focus, asset-based lending focus, which is really receivables and inventory. Depending on jurisdictions, globally, inventory might or might not be financed, depending on how legal structures work, but actual AR inventory financing is a massive market within broad asset-backed financing. So definitely, a lot of segments within that. And then, we definitely use the term specialty finance often, which in my mind, again, people will jump in, I'm sure. In my mind, that means everything from a fintech business all the way through a company that's just a credit card lender or a short-term consumer lender or a small business lender or a short-term real estate bridge lender. That all fits within the specialty finance kind of umbrella under asset-based finance, broadly. On the NAV and fund finance side of things, I think you have three broad sectors the way that we look at it. I think you have a GP financing, which certainly is something I think a later panel will probably talk a lot more about. Is something that certainly is available in pockets. And then you have fund financing, which can take the form of financing the fund to get capital back to an LP, which is probably something that a lot of people don't like to do, but is out there. And then you've also got fund financing, which provides just leverage to a fund, enabling them to go out and further invest in other assets, for the fund. So a lot of different areas, and I think a lot of us probably play in the different areas in different bits and pieces. But having been in asset-backed financing for over 25 years now, gosh, actually more than that. Anyway, it's certainly certainly seen a massive rise over the last kind of 10 years, certainly for our firm, into all these different areas, and each of them now have really grown into very, very significant asset categories.
Thank you. Boris,
Yeah,
do you want to like tell him he's wrong? Or?
Yeah, please
I
do.
probably want to avoid that because, as we've
I'm
just
off.
learned, Jason's been in this business since I was in short. So I'd probably get into trouble there. But I mean, obviously, asset-backed finance is a very broad church, as you touched upon. There's hard assets, auto loans, etc., and bridge financing for construction projects, etc. We obviously are more focused on the more receivables invoice financing end of the spectrum, except our business, we expect to see receivables generated by subscriptions and then lend against those. So we are almost, as if it were not complex enough, we're expanding those kinds of assets that can be lent against. I think that the tech will continue to expand that pool of assets that we can see being underlying the kind of loans that we're going to see originating in the space. And then in terms of fund finance, it's not really something that we particularly look at. We're more on that asset-backed end. So yeah.
And with all of that, Paddy, it's very complicated. It needs complex legal structures. Many of those actually based out of Ireland. What sort of legal structures do you see used or that are more specific to these sorts of strategies?
Yeah, thanks, Tom. Well, look, Ireland is, a very well-established jurisdiction for the establishment of legal structures for, investment in a broad variety of asset classes, including credit. There are two kind of really competing jurisdictions for that work. That's Luxembourg and Ireland. Both jurisdictions have, have very credible offerings and have kind of sophisticated kind of service provider ecosystems who are familiar with the product. I'm an Irish lawyer, so I'm going to put on the green jersey now, and that's all you're going to hear about Luxembourg for the rest of the day. I think traditionally when we looked at legal structures that were used for kind of direct lending or loan origination, in the early days it was a Section 110 SPV that was used. And in those instances, the Section 110 SPV might have been funded by kind of one or more offshore funds. The Section 110 SPV still works well for direct lending and for loan origination strategies, and managers tend to like it for a variety of reasons, including the Section 110 SPV can get access to Ireland's robust double taxation treaty network. So we currently have 74 double taxation treaties, and that makes the vehicle a very efficient vehicle for lending into double taxation treaty jurisdictions. The other great thing about Section 110 SPV is that it's a very cost-effective and tax-efficient vehicle. So the vehicle can be structured to be effectively tax-flat from a corporate tax perspective. And in terms of like ongoing running and establishment costs, it compares very well against regulated fund products or other kind of vehicles in other jurisdictions. We're fortunate that the Section 110 tax regime is enshrined in legislation in Ireland. That means we're not relying on kind of concessionary treatment from tax authorities or tax rulings. And that gives investors and managers great certainty in terms of how the tax treatment of the vehicle will operate once the qualifying conditions of the regime are met. It's also a very flexible vehicle, so the Section 110 SPV can acquire a broad range of financial assets, and there is no kind of statutory restrictions on redemptions. There are no leverage limits that apply to a Section 110 SPV, and generally just it is a flexible vehicle. It's unregulated, which means there's no regulatory approval process required to set up a Section 110 SPV. So that makes the vehicle, very, very quick and efficient to set up. You could be up and running in a couple of weeks. Outside of that, then, kind of Ireland has a full kind of suite of regulated fund products that are available and are used for kind of these strategies. Principal among them would be the Irish Investment Limited Partnership and then the ICAV. I'm going to speak more about the ICAV because that's the vehicle that would most commonly be used. The Irish ICAV is the Irish Collective Asset Management Vehicle. It is a dedicated corporate fund structure. It's typically established as an umbrella structure with segregated assets and liabilities between sub-funds. This is a regulated product, so you will need a regulatory wrapper to go along with that product. And that wrapper can take the form of the QAIF, so the Qualifying Investor Alternative Investment Fund, the LQAIF, which is a particular type of loan origination QAIF, the UCITS or the LTIF. The LQAIF, again, the LQAIF ICAV would work very well as a vehicle for private credit or direct lending strategies, again for a variety of reasons, many of which are kind of tax efficiencies. So kind of all incomes and gains on the underlying portfolio can accrue in the ICAV vehicle free from Irish tax. There's no withholding tax on distributions from the ICAV to non-resident investors, provided that there is a non-residence declaration. There are no stamp or other kind of capital duties that apply to issues, transfers or redemptions of shares in an Irish ICAV. And the Irish ICAV as a corporate vehicle should have access, Irish tax resident corporate vehicle should have access to Ireland's double taxation treaty network, which again makes it a very tax efficient vehicle for lending into tax treaty jurisdictions and including the US if the requirements of the US-Ireland double taxation treaty network or double taxation treaty are met. Maybe just also to add that I suppose the Irish ICAV, the loan origination ICAV, is required to appoint a European alternative investment manager, and that means you can avail of the AFMD marketing passport to market a product throughout Europe. So that is, again, another kind of very useful vehicle for kind of private credit strategies. And then maybe just a word on kind of some structural evolutions that we've seen more recently. To my mind, this is the perfect marriage. It is the hybrid ICAV Section 110 company. And so with that structure, effectively a Section 110 company is incorporated as a wholly owned subsidiary of an ICAV sub-fund. And effectively, that's very efficient because it converts kind of interest income at the level of the Section 110 SPV to equity returns at the level of the ICAV, which, as I said, can be distributed without any withholding tax to non-resident investors and minimum tax leakage in the structure. So that's very useful. It's also a very useful structure for accessing the double taxation treaty network because you have a kind of a robust double-tier Irish structure with an Irish Section 110 company at the bottom that's subject to tax. So again, very kind of tax-efficient vehicle. It also works well for those kind of investing in distressed credit, where you're going to realise big gains, and works very well for kind of the recently introduced interest limitation rules in Europe. So in summary, there's a broad suite of vehicles. I've only touched on two. I could talk about them all, but I probably should let someone else have a turn.
Well, these things, as they grow, they need ratings. They need to be properly understood. Martha, that's your sort of realm. I know with sort of private credit CLOs, for example, we've had in the US they've grown quite a lot, but it's also been very difficult to have them. I don't think we've had any in Europe.
We haven't had any, although we've had discussions.
Yes, and part of that difficulty is from the rating side. So what's really important for you?
Yeah, I mean, if we think about what ratings represent and what is the reason behind it, the key sort of driver is the need for transparency. Private markets have become literally half of the non-banking investment funds available out there. And that's about 10 to 12 trillion, although the number depends on who you ask. And certainly private market and private credit is about 1.3, 1.5 trillion, again, depending on who you ask, and some estimates are actually higher. So the relevancy for transparency in this marketplace has actually grown over time, and it actually will increase as there's more and more interest. In terms of, broadly speaking, everybody knows what the asset-backed rating methodologies is, so I won't touch about that. But what brings us here today is the private markets. And essentially, within S&P Ratings, we have two fundamental criteria to tackle the main drivers or the main investment vehicles that are behind this increased demand. The first bit is actually the second bit Jason mentioned, which is the NAV financing and the sublines and the feeder funds. We've actually had criteria on this since 2006. It has been in use. It started with public equity markets, then it moved into private equity markets, and then increased to other exposures like venture funds, hedge funds, etc. And the key sort of interesting bit about that criteria is it has two components of it. So it's a more holistic approach than what you would expect in CLO mid-markets, and I'll touch upon that a bit later. This is a more holistic approach because very often these funds get established with no assets. So it's all to do with the manager and the track record of the manager, the style of the manager, and the sort of the strategy it intends to employ or deploy over a period of time. And then we get to the quantitative bits, which is the risk assessment, which is basically how do you match the sources and uses of your funds and the ability of that fund to actually repay the recourse liabilities over the period of time as and when they become due under what we call a moderate stress scenario. So what we model in these structures is basically the great financial crisis happening again and again and again. So that's the first bucket, and that is a little bit different to the mid-market CLO.
Yeah.
And the mid-market CLO usually sort of starts off with defined assets. So you already have the assets within the intended structure that you're planning to run. And the difference between the mid-market CLO and the typical BSL CLO, for example, is that it is the only thing that it is different is the key inputs. So the way we derive the asset rating, the ratings of the obligor. And for mid-market CLOs, because these are smaller companies, these are usually requested by third parties. So it's usually the manager that requests for us to do the ratings analysis rather than the issuer, which is typically the case for a public rating. So what we do is we have credit estimates for companies that have below 500 million of issuance in terms of debt, and for companies with above 500 million, which are actually happening more and more in the US and in Europe as well, we have what is called the PCA, which is private credit analysis, which comes with a bit more write-up, essentially. But the difference is that it's a point-in-time rating. So you don't have the benefit of the analyst sitting with management, discussing overall strategy, et cetera, et cetera. It's just a point-in-time desktop rating. But it's a fairly good indicator of the creditworthiness of the underlying borrower or the obligor. What we do see in Europe, and there's a significant interest in Europe for the last, I would say, 24 months, but really there's been two major obstacles that are sort of posing managers. One is FX risk. So we're not like the US. We don't have single currency, although I would like to say we do. A lot of the time, the investments are actually made in three basic main currencies: US, GBP, so British pound, and euro. There's also a big Scandinavian market as well, but for much smaller companies. So getting over that FX risk is key. And why is that key? Because it makes the structure very expensive, and it limits the structuring that you would normally see in a typical CLO or BSL CLO. So probably it limits you to having two tranches, a senior tranche, a mezz tranche, and then there's equity. The other sort of limitation is diversification. So the pool of assets available to be invested in mid-market CLOs in Europe is arguably smaller than the US. I would argue over time we've actually sort of grown as a marketplace for private lending, and I do think there's at least one or two managers to date that are actually very close to solving both of these problems. And hopefully by end of the year, I cannot say that, Hopefully by the end of the year, we would actually see at least one European mid-market CLO. We remain hopeful. You said that last year.
I was
So
gonna
I
say.
hope, I hope actually 2024 is going to be the year when we definitely are right about that.
Great. And Neha, can you kind of put all of this into perspective in terms of like how important private credit's become in European finance?
Sure. So, in general, private credit has emerged as one of the leading sources of financing for life fund issuers. And we saw the positives and negatives of that sort of come through in the last 5 years. But just to put some numbers in perspective, the AUM for European private debt today is about 500 billion, give or take. And it was half that size, less than half that size pre-COVID. So we've really taken off in terms of the need for this kind of financing and the availability of this financing in Europe as well as US. US is equally staggering. It's about $1 trillion, and it was just less than 500 billion about 5 or 6 years ago. So, and some other things that the differences that emerge between US and Europe, I'll name a few. First is just the importance of private financing in Europe is a lot higher than in the US. So, and it comes through in numbers. If you look at the BSL index in Europe, it's about 300 billion. So it's actually smaller than the size of private credit AUM. We don't have, in US it's about equal. I would say BSL is actually a little bit bigger than private markets. So right off the bat, the capital raise or the capital availability for leverage financing is higher. It's about 40% in Europe, and in US it's about 25%. So the European market is just a lot more dependent on in those sort of financing. Again, a couple of reasons in how these structures have evolved and how this financing has evolved. Firstly, banks are a lot bigger player here than in the US. In the US, the banks have basically been ring fenced out of a certain area, and we've been instructed not to play outside that ring fence. And so that has just created tremendous opportunity for private credit. But here, banks are still a big player, and so that sort of limits the opportunity for institutional investment. And then also, we also have retail as a big player in US, which is not so much of a case in Europe. So all these factors combined, we see more influence of private capital. Now, overall, if you take a step back as to why private capital in general has become so big, well, performance is a big leading indicator. So, and this has become even more observable over 2022 and 23, where we saw most of the public investments, public markets sort of dip down and private markets outperform. And this is especially true for private debt. In 2023, private equity actually dipped into negative returns, and private credit, along with BSL, was the top of the It was like top of the leaderboard in terms of last 12-month performance. So that's a good leading indicator into how much inflows you're going to get in the foreseeable future. In Europe, I think private capital has done even better than the US. About 1 or 2% better on an LTM basis. European private capital has returned close to 14-15%. US private capital about 11-12% on a look back 12-month basis. And then final thing I'll say is that there's also a need for this financing, not just from the issuer side, which is very clear now. As banks stepped back in 2022, private capital came in and rescued many issuers, thereby sort of depressing the default rates, which is great from issuer point of view and also investor point of view. But also, we also have to understand that there's a need from the investor side for diversification. And so we are increasingly hearing more pension funds, insurance companies make place for permanent allocations in their portfolios to private assets, whether that's private equity or private credit. And then in a higher for longer rate environment, allocations naturally gravitate towards the top of the capital structure. So now we are seeing where where pension funds and insurance companies are saying, hey, we want to maintain our allocations to private capital, but we just want to move up the stack, less on private equity and more in private debt. So all these factors combined have sort of come together to sort of spur this burst of growth.
And lastly, in our sort of overview, Suraj, your clients are often investors. What do they really look for when it comes to things like data and transparency? I know Martha touched on some of those ideas. But.
Yeah, and I can pick up on what everybody is saying, that it is, transparency is big. We largely play in the consumer space, which, starting from Neha's comment about insurance, capital allocation, like a lot of those markets have not been available in the public securitization space for insurance companies, so they are going more and more into the private credit space, even in the consumer, whether it's just plain mortgages to all other consumer, like bridge loans, which are kind of like maybe resi mortgage adjacent, all the way into buy now, pay later loans, and both in US and Europe. So one of the things there is just speaking from the US insurance space, mortgage-like loans are treated as whole loans, and they're allowed to invest in those without needing a securitization and a rating wrapper, but everything else requires a rating wrapper. So ratings and that level of transparency is pretty big. From the investor point of view, I think one of the alphas that investors bring to the private credit space is their ability to understand structures and manage credit and work with their counterparties. So again, focusing on the consumer side, our clients want the transparency of understanding the underlying credit, not only at the time of investment, but more importantly on a regular basis. They want to get daily, weekly updates on what's happening, so they can work very closely with their counterparties to resolve any issues and manage any credit downturns. And that is also working well in the European markets, where you don't like what the U.S. did around the global financial crisis, is to use the foreclosure as the mode of resolving some of the credit issues, which didn't work well at all. But like loan modifications and doing that more proactively also works very well with having that data transparency. And then the other big advantage of private credit structures is that we can also manage the counterparty risk and counterparty exposure. So you also know, like, okay, what's the health of the lender, what's the health of the servicer who's managing the transaction. The good news is that technology has come a long way. Data sharing on the cloud, it can be done instantaneously. You can very well manage privacy issues, but that's one big issue in the consumer space, is that lenders obviously don't want to share the borrower level information, but they can still share performance almost in real time through cloud-based sharing options. Being a technology firm, I can't not mention AI. AI does make the data mapping much easier, so that investors can manage large commitments in a more efficient way. So there's definitely, in the consumer space, it's like you don't always get it, but it's like all our investors do need that transparency.
Right. So thank you all for that little overview. Oh.
Sorry, just wanted to add, and that transparency sort of is also related on the valuation side of things as well. So getting a third-party confirmation of what your assumptions are in terms of the stress tests and the underlying asset valuation is also helpful. And again, the other aspect is the benchmarking. And now I know a lot of these NAV financings and subscription lines, and also the first mid-market CLO in Europe will likely be private, not publicly available, but it sort of helps the managers of funds or the LPs to basically assess not just the underlying fundamental risk of the credit or the exposure that they're managing, but also to allow them benchmarking between sort of the different pools of capital. And to Nia's point, it helps with allocation and allocation decisions, and obviously the growth of the marketplace. So transparency, both in terms of underlying and data overall aggregation, would actually be a key driver for further growth of this marketplace.
Yeah. So we're going to try and move on to the sort of looking at the macro side a little bit now. So obviously we mentioned higher for longer, and I feel like everyone's in that agreement now. Maybe if we start with Jason, sort of how will the sector manage higher for longer going forward?
Sure. Look, I think on the private credit side for a fund, like ours, we raise capital. The capital has a hurdle return where the managers get money and has a hurdle return that the investors get money. And depending on the makeup of the asset and depending on the makeup of the investor, this higher for longer kind of period that I think we all think that we're in is actually very beneficial. For us, we can compete very much directly with a bank mezzanine solution, which is pretty common in private debt. You'll often see a bank in some structures, certainly in the US and obviously over here, and you see a mezzanine provider, and so a unitranche provider like us can be incredibly competitive in this higher rate environment because we probably have a mid-single digit kind of minimum hurdle and a higher single, low double digit return requirement. So with rates being higher, we're able to be very, very competitive. And last year actually was, I think, our largest deployment / new deal year in our 17-year history. So, so the environment for us right now is very good globally. Some markets much, much better. We do a lot in Latin America, and that's an incredibly good market for us right now. But the deals we're seeing in Europe and competing against, on in Europe, because of our fund structures, which I think are very similar to a lot of other fund structures, the way the hurdles work, private credit funds can compete, incredibly well. So, I selfishly hope this can continue for a little while because, deal activity continues to be very robust.
Neha, Boris, anyone want to add?
Yeah, I think the competitive tension between BSL and private credit lending has been here, and it actually for a while. It isn't just about providing a liquidity gap when liquidity is needed. I think private credit is here to stay, and it's actually a good thing for everyone because a competition is always good because it leads to innovation, creativity, and it also sort of leads to growth because credits that arguably were limited to, in Europe, typical bank financing, et cetera, and had to cap their growth ambitions, could actually sort of reach out to somebody that thinks a little bit outside a certain border or certain borders. So it's actually a good thing. But again, sort of with great power comes great responsibility, as Peter Parker was told. And I do think, that need for transparency and sort of breaking down of that barrier would actually sort of be essential to further unlocking that further growth potential that is inherent in the marketplace.
Yeah. Should we go with Boris and then Neha?
Sorry. I mean, from our perspective, we've seen a lot of competitors in the revenue-based financing space take advantage of that low-rate environment that we saw. Some look back on misty-eyed a few years ago, and that has actually driven quite a lot of issues for those businesses, perhaps because they haven't put enough focus on risk management or underwriting of who they're lending to. The objective was, in a nutshell, raise as much cheap debt as you possibly can and get it out the door, right? And then it sort of comes home to roost when you're whipsawed by interest rates and you've got a variable rate on that line of credit, and suddenly low-performing or non-performing risk that you have in your portfolio becomes a real burden and a problem. And because we're peer-to-peer, because we approach it in an off-balance sheet way, we just facilitate the transaction, we have had to focus entirely on the risk management side rather than necessarily approaching it from just trying to disperse as much as possible. And so now that we're approaching, we're setting up a special purpose vehicle and we're approaching that stage, we're able to lend to rather price unconscious end clients, so we're not really exposed by a higher interest rate. Everybody's going to make plenty of money regardless, but we're also protected more by having a much more robust underwriting and risk management system that takes place before we're comfortable lending.
Yeah. And Neha, what sort of challenges do you see?
Yeah, so I was going to say, just from a research point of view, it's important to acknowledge sort of both sides of the coin. To me, higher interest rates, they're a double-edged sword. So on the one hand, it's great for investors because there is this increasing need for yield and the ability to make higher returns because of higher base rates, and we can see why there is this inflow of capital into floating rate funds and CLOs, and any floating rate product is just attracting a tremendous amount of demand. But on the other side of the ledger, you also have issuers that are unable to meet that interest cost. And we've seen that persistently in declining coverage ratios. We had flagged this risk about 18 months ago when we first saw sticky inflation higher for longer. And we've been saying that we have to keep an eye on that bottom 10, 5 to 10% of issuers that will not be able to meet the higher outgoings and will need some sort of additional help from investors. And so we've seen that consistently play out. And that leads me directly into the challenges of higher for longer. Advantages are there, high returns for investors. The challenges, critically, we've seen some pockets of leverage finance where coverage has fallen below one times, which essentially means that borrowers are not able to pay their basic interest outgoings. And that's concentrated in the CCC part of the market. There are some B3s that are on the way to CCCs. We've had a huge downgrade wave in US BSL loans, not so much in Europe, but that could come in higher for longer. We also have our eyes on non-sponsored loans because essentially when push comes to shove, they have very little ability to raise liquidity when their back's against the wall. And then also some high levered pockets within LevFin. There are some unitranches, which has been a great product. It fits a niche, but at the same time, these are 1L, 2L combined, highly levered. And there have been some questionable deals made in essentially the year 2021, which was the peak of the cycle. So you kind of have to balance that. And the higher for longer, it's a great divider between the winners and the losers. The winners will be the issuers that can pay those higher interest costs and thereby will attract a lot of capital inflow, and then the losers will be those that succumb and are not able to function in a higher for longer rate environment.
Yeah. One thing to add, so just a couple of things. I think that's really true, and I think to Boris's point, it's like showing up in risk management in newer deals, and we are of the same opinion as Jason. We like this because that's where like higher rates does lead to more private credit investments, and now we're seeing wealth, also high net worth and wealth managers also coming into the space, so more asset managers are allocating capital to private credit, but yeah, risk and how the structures work are definitely more in focus now.
Yeah, and then moving on slightly, Paddy, you touched on some of the regulations, but are there any in particular that are coming down the track that are going to have a big impact on the sector?
Well, I suppose post great financial crisis in Europe, we're living in an environment of kind of constant regulatory evolution. It's interesting, actually, I dropped into a panel yesterday on kind of Basel 3.1, which is coming down the tracks, and the potential for that to create opportunities for non-bank lenders to maybe fill gaps where banks may be pulling back from certain areas. But the real takeaway for me from that panel was actually that these regulatory developments create a new opportunity set for kind of like non-bank lenders, and then potentially banks provide finance to non-bank lenders, and it's just an interesting kind of segue. Possibly, I digress. So looking at kind of some of the legislative developments that will impact structures that we work on or that we advise on. Two kind of pieces of fund legislation that are of kind of great interest to my funds colleagues are kind of AIFMD2, which for the first time will introduce a kind of harmonised loan origination framework for AIFs, alternative investment funds, across Europe. Prior to that, there was not one. In Ireland, we did have a kind of a loan origination regime that applied to our loan origination AIFs, and so I think my colleagues in our funds team are kind of have been kind of working in that within that framework for some time, and they expect an uptick in kind of loan origination QAIFs, as a result of that. Then also there's kind of ELTIF 2.0. So there was kind of an original ELTIF, which is the European Long-Term Investment Fund framework in Europe. That was updated and revamped in January of 2024. And there are kind of two really interesting pieces to that legislation. which are kind of coming together of kind of liquid and illiquid classes, but also kind of the potential for the LTIF to be used and to be marketed to retail and professional investors. And so there has been kind of a lot of chatter around the retailization of private credit, and I think it remains to be seen whether the LTIF wrapper will be used to kind of raise and deploy that capital at scale. I don't know, Jason, if you have any kind of thoughts around kind of...
Yeah, I mean, I think maybe I'll step back for a second. I mean, I think that, if I go back 15 years ago, any of these kinds of discussions you had with anyone, or you walk into an investor, 3/4 of the time they look at you and like, well, what are you talking about private credit? This is just ridiculous. And then fast forward, and I think 8 or 9 years ago, we did a publicly listed trust in the UK that we still have. We have a retail fund in Canada, where I go and sit in front of a bunch of investment advisors and try and explain what private credit is too, which is an interesting discussion. And now we're on our second rated fund, which is mostly insurance company money at this point, and we've gone from raising these small funds as a small manager that are in the hundreds of thousands to now we're on our second $2.5 billion fund. So it's all this an evolution. I think all these products, I think, are just going to give more managers like us, the little tiny ones, not, I'll say Apollo and Ares, obviously, not the gigantic ones that no one's ever going to get. No one's ever going to lose their job for giving them money. They'll lose their job for giving me money. It's just going to give a lot more managers opportunities to raise capital and go and find deals and help expand, the universe by getting it out. And I, certainly think that some of these new structures are going to be hopefully interesting to us, as we continue to grow and scale and hopefully, have a reputation that can allow us to do some of these things.
Right, so I'm just a little bit worried about time, because as you can see, there's questions popping up, and I would like to give us a little bit of time on those. One of the things we were scheduled to talk about was like ESG and data. ESG, it feels like it's dropped off the radar since rates went up, really, to some degree. Is it still important to you guys, to investors? And maybe, secondly, how can private credit develop to ensure that it remains important? I don't know who would like to start that one. You can raise your hand if you like. Go on then.
I can address that, or start to address that. So ESG is very much at the forefront, but it's sort of embedded in investment decision. Because I think there were several efforts being made about scoring, et cetera, and there's various sort of pros and cons in doing that. Standardization is one of the pros, but one of the cons is everybody considers E, S, and G slightly differently and from a different perspective. Does it impact the credit? Is that an ESG score? Or does it impact the environment? Is that an ESG score, for example? So there's sort of various different approaches. What we have seen at the moment is a proliferation of third-party evaluations, where sort of you help managers and also investors to assess that risk, not only from the point of view of credit risk, but also, like I said, the impact on the environment, the social and the governance issues as well that are relevant. I'll pause there because this is sort of a this is a totally different panel by itself.
Yeah, we had a lot to go through.
And I think it will continue to do so. To be so.
Well, maybe in the sense of trying to answer some of these questions, we were going to talk a little bit about lack of transparency. With Suraj, maybe take you on this first. But that first question says, how do you expect regulators to react to the rise of credit given the inherent lack of transparency? What do you think is most likely to come?
Yeah, I mean, I can talk about that even in the kind of the context of ESG as well. The one thing that in the consumer space, what private credit has done is that, and a lot in Latin America, is that it does provide credit for underserved, right, unserved borrowers, which is great. And there are some funds who have taken advantage, leveraged that in the S space for ESG for sure. But that also comes with a lot of regulatory scrutiny. So this is both the Consumer Finance Protection Bureau, CFPB in the US, is working closely with the EU Commission on that consumer aspect of private credit because that transparency is lacking. And they specifically focused on buy now, pay later loans because those are becoming very big in both, well, all markets really. So there is, I think, that a scrutiny around that transparency, and there is new regulation coming on that specific, on like having the CFPB guidance and EU Commission guidance on how borrowers are served, how loans are modified, and credit is monitored at that level. So.
And I'll just quickly add, because I think it's important. Now, we've obviously seen increasing regulatory scrutiny both in the both sides of the pond, US and Europe. And not a single day goes by without a negative headline about private credit. Some of them are misplaced, but some of them are rightfully asking about transparency. Yeah. And I think, to Patty's point, the retailization of private credit is ultimately, in my opinion, a step in the wrong direction if you're trying to prevent regulatory scrutiny. So the more we tap retail funds for private credit, the more in focus we become. Yeah. In the eyes of the regulators, and the more questions thereby will ultimately arrive.
I think it's important because these funds, private or not, they're still exposed to the same fundamental risks as every other market is, both in terms of macro and micro as well. So the underlying asset. So and being such a large component of the financial system, it does sort of expose question marks about how do you sort of monitor potentials for systemic risk. And if you have a big part of the equation remaining hidden or unknown, it does expose the overall system, governance, and also central banks to sort of potentially more volatility inherent in the system than they actually are currently modeling, as it were.
Yeah. Maybe I could jump in. I look at transparency in two ways. One is toward, on the investor side. One is towards retail investors, and one is towards institutional investors. I can absolutely say that any large private credit fund, an institutional investor sees everything. They see every investment memo. They see every document we get. They see absolutely everything. On the retail side, things are more synthesized down, but the access to the manager is there. So as I kind of said earlier, I would go and sit in front of just regular investors plus their money manager and talk about our deals in great depth. So I actually think transparency is super important for allowing people to understand the asset class, get comfortable with a manager and what they're trying to do, and why what they do differentiates themselves to a competitor or differentiates themselves to a bank or whatever the other competing environment is. And I think funds that are not transparent and don't give the kind of information that an investor really needs to understand to really want to get involved more heavily in private credit is missing out. And so I'm hopeful that people are just going to do that naturally, irrespective of what happens from a regulatory standpoint, because one, it's the right thing to do, and two, it's really how a fund's going to be able to get more capital in the door to invest. There's two very simple reasons for me.
I guess alongside that sort of transparency question, there's the other very popular question is, how do the banks sit in all of this? Some are collaborating rather famously in some cases, some doing well, some appearing to do not so well. Surely long term they're going to be more involved. Maybe Neha, should we start with you and then Boris?
Sure. Look, I think the rise of private credit is very structural in nature. We've been saying that for a long time. Now, granted, there'll be cycles in that structural trend upwards, but this is a pool of capital that's essential for our credit ecosystem. And I think most parties have recognized that. And I think most are here to play nice and most are here to collaborate. And so we're seeing the need for bank capital in some middle market deals as well. I mean, there's the need for the revolver. There's some higher attachment points that banks just naturally lend themselves well to. So I don't see the need of banks going away. And also I think we have to recognize that these two markets, that the institutional and the private market, issuers are increasingly straddling these markets. It's become increasingly easy for issuers to go back and forth, especially the upper middle market. And we've seen that tremendously in the US, where for the first time we saw deals actually getting repriced or refinanced out of private credit to institutional space because the sponsors are getting 100, 200, 300 basis points coupon cuts in institutional markets because because equity markets were rallying, and on the flip side we saw the opposite in 2022 and 3 where deals were going to private credit because the bank balance sheets were not open. They were not open for business. So I think this is an important thing to remember, and I think even from the investor point of view, the capital that is coming in ultimately to lend to institutional BSL deals. Ultimately, the same pool of capital is also being routed through private platforms to middle markets. So this is it's an increasingly collaborative activity, I would say.
Yeah, Boris?
I mean, I think from our perspective, lending into SME space, banks are under enormous amounts of pressure from governments as well to get involved and to step in. There is 60+% of the economy is actually built on, at least in the UK, is built on businesses that have less than 15, 20 employees. So it is incredibly difficult for banks to continue to underserve such a large segment of the economy. They're under pressure not only from governments, but also it just doesn't make economic sense to allow that much potential business to walk past the shop front window. So I think they will continue to have a role. I think that role will expand, but I think there's also a friction-reducing role which private credit has in bridging the gap between, okay, banks don't necessarily want to get involved in the granular work required to price all of these very, very small loans. So how do we, as private credit professionals and managers, in you guys' case, wrap that in a way that can be consumed by banks without sticking in the throat quite so much?
Okay, well, I can see the timer is ticking very rapidly on us. Thank you all for your insights today, and thank you all for listening. Hope you enjoyed it. And next up, Joel Holsinger from Ares is going to talk to me for about half an hour. And yeah, thank you.
Thank you.
Thank you.
Oh.